Momentum is red, and it's not going to change. It's not shifting. Again, we're watching this environment of a lot of chop. This is a squeeze today, exactly as Mark Sebastian called earlier this morning. Now we are starting to level off, sell off a little bit. And now what we're looking for is a possibility of a little bit of an uptick tomorrow and Wednesday. Historically, there is something known as pre-FOMC drift. You type that into the old Googles, and you get this long academic paper by David Luca and Emmanuel Monch. This is an explanation that historically, tons and tons and tons of the annualized returns for the S&P 500 come within 48 hours of the S&P of the Federal Reserve's announcements. Now, this disappeared. This was a phenomenon that was happening a lot in the 1990s. It happened a lot during the first half of the 2010s. But then when the Federal Reserve started to pump, I don't know, say $8 trillion into the economy over a period of 13 years, this didn't matter as much. Well, now that the Federal Reserve is coming back and will be raising rates likely by 75 basis points, we're going to talk about that in a moment, this phenomenon is actually kind of showing up a little bit. So we may see a sell-off tomorrow morning, and then you start to see this drift where the market moves a little bit higher toward that Wednesday announcement. That is going to be at 2 p.m. I will be here with Kenny. We're going to be watching the Fed. And I want you to get to know the Fed today. This is very important, okay? Because as I said last week, if you missed it, a lot of people believe that the President of the United States and that Congress are the most important and powerful people in the economy. And it's not. It might seem that way. It might seem that this is the most important election of your lifetime and the health and the safety of the economy is at risk. Doesn't matter. In the grand scheme of things, it doesn't matter because fiscal policy and executive policy pales in comparison to the impact of the Federal Reserve on the United States economy. The Federal Reserve System was implemented in 1913. You can read The Creature from Jekyll Island. You can read The Lords of Easy Money, which is a new book out by Christopher Leonard. I'm doing a story on that right now. You can also watch any number of movies that have come out over the last couple of years with warnings about the impact of the Fed. Now, back in the day, long before 2008, maybe even before 2002, the Fed didn't impact markets the way that it does now. Now, of course, all anyone is talking about is how many points is the Fed going to raise the rates by? What's Jerome Powell wearing today? Like, these conversations are being had. Is he wearing a red tie or is he wearing a blue tie? Does that matter? Oh, gosh. Call the fashion police. Like, these are legitimate conversations. Now, there is the Federal Reserve System. The key entities are the Fed Board of Governors. That matters, but not that much. The 12 Federal Reserve banks, which are these regional banks around the United States. So if you live in the Indiana territory, you are effectively overseen by the Chicago Federal Reserve. But down here where I am in Florida, overseen by the Bank of Atlanta. There are 12 of them. There is a big old map, and they all have effectively do their own research. Each has a different leader, and some of those leaders of those banks may be members of the Fed Open Market Committee. The Fed Open Market Committee is appointed members of the FOMC who will vote on monetary policy. Now, this is very important, because there are two types of policies in which the economy typically operates. The first is fiscal policy. Fiscal policy is very easy. It's pretty much run by Congress and tax department. Taxation, subsidies, different ways the capital is utilized out into the broad market typically relies on tax revenue that is brought into the system and then spent, or at least that was the old theory before modern monetary theory came along, MMT, and basically has imploded everything and helped to create the inflation that we have in this environment. Fiscal policy does include the subsidies that you just saw for green energy. It would not include, unless an act of Congress came through, the student loan bill. Now, ironically, what's so wild about the student loan bill and whether or not the student loan bill could get passed if it became an act of Congress is that the U.S. government and the White House used the guise of the pandemic as a reason to extend student loan forgiveness. Now, why does that matter? Well, a couple of months ago, when they were kicking around this idea, what they decided to, the Department of Justice and the Department of Education, was to examine the quote-unquote HEROES Act of 2020. That was a bill that effectively allowed certain types of financial forgiveness. And this bill right here that you can read if you don't like eyeballs, this bill effectively was a massive COVID response bill. It provided direct payments to people. It provided a lot of different testing costs, all of this stuff that kind of went through here. And then it did make some notes and changes to the student loans and financial aid. But why does it matter? Why would it matter today? And I want everybody in the chat to think about this. Why does it matter today, Monday, September 19th? On which it is very unlikely that they will be able to fall back on HR 6800 as a COVID-related student forgiveness. Why would this be stopped potentially in court? No, Scott, you can't answer. The reason is because the President of the United States was just on television last night on 60 Minutes and declared that the pandemic is over. Oops, you just blew up your own argument. That actually may be a problem for the student loan bill. The very fact that the President of the United States, now they could say that the President of the United States does not have authority, but the President of the United States is the head of the government, even though the President of the United States said that they would defend Taiwan, and then the White House came out and said that's not the position of the federal government. I got dizzy watching that interview. Don't do it. Don't do it. Let's talk about the Fed. All right. So the key functions of the Fed: conducting the nation's monetary policy. Well, what does that mean? Well, we'll talk about what monetary policy means, but helping to maintain the stability of the financial system. They're doing a great job, aren't they? Supervising and regulating financial institutions. So that is the oversight, the FDIC. You talk about the FDIC, which is the Federal Depositors. That is the regulation of member banks, companies that are Federal Reserve banks. Now, keep in mind, if you look at a dollar, take a dollar out of your pocket and look at it, that is a Federal Reserve note. That is a Federal Reserve note. That is U.S. debt that you are holding in your hand. All of the debt that is provided by the U.S. government, all of that national debt, it is in your pocket. Those notes are for paying for debts, as noted on the pieces of paper themselves. That's important. Fostering payment and settlement system safety and efficiency. That's just jibber jabber for effectively ensuring that capital moves efficiently through the system, and promoting consumer protection and community development. That's not really what they do either. That has been really moved over to the CP, to the Consumer Protection Bureau. Now, the key elements here. All right. We talked about monetary policy. The primary things that happens, the Fed provides reserves to banks. Remember, the Federal Reserve does not work for you. The Federal Reserve is independent from the United States. Now, why does that, from the United States government? Why does that matter? Well, ironically, they did survey this year. Ipsos is the name of the company, and they found that 28% of Americans had no clue what the Federal Reserve did. And only 7% of Americans knew that the Federal Reserve engages in the management of handling inflation, that it is independent, and that it is engaged in interest rate movement. Only about 40% of people knew that interest rates went up in March. About half of Americans believe that the Federal Reserve is doing a good job, and another half do not believe it. The bulk of the people who do not believe it are largely conservatives or Republicans. The people who do believe are typically liberal and Democrats, and independents are right in the middle. Why is that? I don't know. But I would argue that it likely has to do with media consumption and just general survey and analysis and education over time. Okay, anyway, point being that the Federal Reserve provides liquidity to the market, and they do this through the reserves in which they operate. So they're providing their reserves to the banks, so they are easing at that time. They were providing money. Remember, back in March of 2020, when Neil Kashkari, head of the Minneapolis Federal Reserve Bank, came out and said, we have unlimited reserves. Okay, now keep this in mind. The Federal Reserve cannot run out of money. Okay? If you've ever played Monopoly, the 11th rule of the game is that the bank cannot run out of money. So if you do run out of money while playing Monopoly, you are instructed to just start writing numbers on pieces of paper. The Federal Reserve does the same thing. It's basically the exact same operation, which is kind of ironic because the entire purpose of the game when Monopoly was made in 1903 was from someone who was against private property. She was trying to teach people about the dangers of too much capital in the hands of certain individuals, how it can bankrupt economic systems, and she was pro public ownership of private property. Not a lot of people know that. But what ultimately happened with Monopoly, it became a banking game, a game about liquidity, and the most fought over board game in board nights in the United States, according to onlinecasino.ca. So with that, the banks now get, what are the Fed's reserves? It's whatever they want it to be. It is numbers on a computer. It is whatever they want. Now, why does that matter? Because they provide reserves to the banks. The banks are the members of the Fed. So who wins when lots and lots of bonds are made and are purchased by the Fed and sent out into the world? And I'm going to explain this in a second. Who wins? Well, the banks do, and so do the private equity managers. The banks make loans to the public. The public provides deposits to the banks, and round you go. By the public having money in the banks then use that money as leverage. They have capital ratios that are required to ensure that they don't over leverage based on the amount of money that they have in deposits. These are major rules, major lessons that we learned both from 2008 and previous events where there was massive over leverage in the system. Three primary macro things: interest on reserves. Okay, so interest on reserve, that is the Fed funds rate. That is a key number. So you're hearing that number right now is at 2.25%. We're going to go to 3 on Wednesday, 3% for the Fed funds rate. And why does that matter? Well, it matters because historically, we have seen this downward move. If I can draw it, okay? You're going to have to, there you go. What's really interesting about just what that line shows you is that historically, going back to the 1980s, when the Federal Reserve has been cutting its interest rates, it has been trying to increase economic activity. Every time that they have moved up to a specific bound, we've had a crisis, or at least a deep recession. Here's what led up to 87. Here's what led up to the 90s recession. Here is the dot-com bubble. Here is the 2008 crisis. And here is the 2018 crisis, forgive me. We are now moving outside of that line, that downward slope. That is very, very ominous because we haven't had inflation at these levels going back 2008, 2009. Now we're back at, in the 1980s levels with inflation. This chart was made at the beginning of this year, so you're not going to see the number up here where it should be. But the key point is that interest rates are moving out of the trend, and I'm talking a 40-year trend. That is very, very ominous, and that's one of the reasons why we have to be very, very concerned about monetary policy moving forward. It also tells you just how significant the Federal Reserve's rate moves are on the stock market and the broad economy in general. You have big market moves down in 2001, 2008, 2018. As a result, do not be surprised if this market does break and really breaks to the downside. Now, the other things that are involved here, you have quantitative easing. That is a process where the Fed uses its balance sheet, again, whatever they want to say, numbers on a computer, as Ben Bernanke explained. The Federal Reserve will buy bonds, mortgage-backed securities, and other assets from the $23.5 trillion bond market in the mortgage-backed security markets, and the Federal Reserve currently owns $8.3 trillion in assets. Reverse repo agreements, I'm not going to get in on this. I could do an entire day on it, but let's just focus on the interest on reserves and the quantitative easing, because those are the two primary elements that are driving this market right now. So the Fed balance sheet moved to about $8.5 trillion. And as you can see, there's a direct correlation, very casual relationship between the increase in the Federal Reserve's balance sheet and the performance of the S&P 500 over the last decade. More than a decade. So back in 2008, the Federal Reserve started what is known as Operation Twist. It bought hundreds of billions of dollars in bonds, mortgage-backed securities, and other assets to provide liquidity to the market. That money, which keeps bond prices down because you're making sure that there's money in the market and you have the largest buyer of bonds. By the time that the Fed was done up here, it owned 25% of all U.S. Treasuries and 33% of all mortgage-backed securities. That is massive. That is concerning, because what happens when that buyer has to go away? Well, I mentioned that because the idea of tightening or selling bonds back into the market has been an illusion going all the way back to 2009. 2009, the Fed said, yeah, we're eventually going to need to taper our balance sheet. 2011, they came out and said tapering was a priority. 2012, 2013, same thing. What did they do? They increased their balance sheet. And every single time that they have moved to taper or tighten, they balked back in 2018. They were tightening for a little while. They pivoted. It went straight back up in 2020. They're trying to tighten now. They are not meeting their targets right now. And remember, those targets are just targets. Just because they say they are increasing to $95 billion per month doesn't mean that they are actually going to do it. They did a lot in August. They basically did nothing in July. So now we are being told $95 billion. What happened last week? They added $5 billion in mortgage-backed securities. Mortgage-backed securities matter because there's a direct relationship between mortgage-backed securities and housing prices. And these securities were bought en masse in 2009 because these securities imploded during the housing crisis back in 2009 to the point that the Fed owned 33% of these securities. Now, why does that matter? Well, it matters because who benefits? Who benefits from this? As you would know, it's the member banks, Bank of America, JP Morgan, Goldman Sachs, anybody in the space, because, hey, they got a buyer for their products, and they also ensure some stability from the liquidity provided by the banks. But also, who else benefits? BlackRock. All of the big institutions that have been loading up on new homes over the last 2, 3, 4 years. Think about the insanity of last year. Last year, we have inflation that is raging. We have home prices that are surging. And mortgage-backed securities help keep interest rates lower, providing liquidity to the market, reducing the spreads. That's important. Now, obviously, at the same time that they're providing that liquidity and keeping the spreads on those products low, they're also keeping interest rates low. That is fuel on the fire. That is how you create a bubble. So BlackRock, a lot of other companies, TCN is one of them, came in and started buying up homes, entire developments in states like Florida, Arizona, Texas. Jacksonville, the largest number of new buyers, I believe, were funds over the last 2 years. Well, look at this chart, because while they're saying that inflation is transitory, they're buying more mortgage-backed securities. They're manipulating the housing market. So who does it benefit? Well, it benefits the big banks. It benefits BlackRock. And BlackRock doesn't have to sell all those homes in the next 2-3 years. I know that a couple people are predicting that they will, but they don't have to do it because private equity firms have a 7 to 10 year return horizon. They don't need to dump all those assets. And again, you'd be talking about certain companies who might be dumping entire developments in certain states, in places like Florida, in Orlando, Jacksonville, Tampa, up even near Sarasota. So the Federal Reserve, while saying inflation is transitory, is providing more fuel in the fire in the inflationary elements of the housing market. That's the insanity of last year. And I think if you take one thing away from today, that would be it. Because This may benefit some homeowners in the United States, people who bought a couple of years ago. I bought in 2020, right when this nonsense started. I've watched housing around me go up numbers that make no mathematical sense. It makes no sense that a piece of land that was uncleared went from $100,000 to $500,000 in 18 months. It doesn't make sense. That is a big red flag for me. Some of the homeowners make money. Hey, that's great. But who gets really screwed? It's the people who are playing Monopoly, who go all the way around the board, and the only time that they get to do anything is when they collect money to pay to pass go. And that is their entire life. And they've been doing it for a long time. So this is pricing out homeowners once again. It is suckering people back in to chase these assets right now because they believe that home prices aren't going to be this low once again, or interest rates aren't going to be this low once again. People, I think, learned in 2008. This housing market can and will go lower. The Fed is going to try to provide as much support as possible. Don't be shocked if they are not selling their mortgage-backed securities. And again, I go back to this line here because this is what's coming up on Wednesday. The Federal Reserve is really behind on inflation. Now, inflation is up here now. So this is an outdated chart. I apologize. Inflation's up here. Interest rates are still here. We have never, as you can see, brought inflation down without bringing the interest rate level, the yellow level, above the green line. See, look at this period right here. We didn't get inflation down. We brought it up, and then everything imploded again. Market goes lower. We kept it flat again. We kept it flat again. We kept it flat again. And now here we are trying to fight this monster all over again. This has never been accomplished. 2 consecutive prints of 5% for CPI has never, ever seen an environment where inflation lowers on its own. So that is why I continue to say, pay very close attention to what is happening at CME Group. CME Fed Watch. This is the name of it. And you can see people are saying, well, wait a minute, why did the market go up a little bit today? Well, it went up a little bit today because we saw a squeeze out of some of the people who were betting the Fed is going to go up 100 basis points on Wednesday. People are betting because they read a report by Nomura that the Fed would go up 100 points. Unlikely to happen. So this has to get squeezed out. All of this needs to be squeezed out. So when the Fed goes to 75, that's why you may anticipate a rally on Wednesday at 2:30. That's why I'm going to be here with Kenny. So make sure that you watch us. And in the meantime, know how to get out in front ahead of this, in the world's biggest trade. The other thing, the numbers have just come out for December of next year. And the baseline estimate, the one at the top of the bell curve, is still 4% for the end of the year next year. I'm going to talk about why that matters tomorrow and why that actually may be a very bullish figure as we get into the November Fed meeting. If we move very, very aggressively, you're going to see these odds of being cut under 4% start to disappear. And at that point, there's going to be some opportunity here to find a bottom on a lot of different stocks in companies that matter in an environment that would be very successful and survive in an environment where Fed interest rates are at 4%. All right. That's what I got.